Welcome to this presentation of Chapter 7, devoted to long-term care insurance. The objective of the chapter is to build an actuarial framework for contracts that provide financial protection when an insured person becomes dependent and needs long-term assistance. The focus is on total dependency, and more precisely on annuity benefits paid after dependency and until death. This topic is central for life and health insurance because it combines demographic aging, morbidity, mortality after disability, benefit design, and reserving. It also raises important public policy questions since the cost of assistance is generally shared between public authorities, households, and private insurers. The chapter therefore has a dual perspective. It first clarifies the nature of the insured risk and the way dependency can be measured in contracts. It then develops a semi-Markov multi-state model, which is better suited than a simple Markov model because the mortality of dependent individuals depends strongly on the time already spent in dependency. Finally, the chapter derives pricing and reserving formulas for long-term care annuities, both with cause-specific waiting periods and with a uniform waiting period. This first section gives the roadmap of the chapter. The presentation will start from the actuarial problem, namely how to value and reserve long-term care annuity contracts. It will then explain why a semi-Markov structure is needed and how this structure leads naturally to pricing and reserving formulas. The chapter studies long-term care insurance contracts in which the benefit is an annuity paid once the insured enters total dependency. The contract is therefore not simply a mortality product. It requires the actuary to model the timing of dependency, the duration spent in dependency, and the death time after dependency. This is why the chapter introduces a hierarchical semi-Markov model with an autonomous state, several cause-specific dependent states, and an absorbing death state. The hierarchy means that the insured can visit each state at most once. Starting from autonomy, the insured may either die directly or enter dependency because of one medical cause and then eventually die. The central actuarial point is that mortality after dependency is not adequately represented by age alone. It also depends on the duration already spent in dependency, the cause of entry, sex, and the age at which dependency began. The chapter then uses this model to derive expected present values, unisex premiums, mathematical reserves, and Thiele equations. Two product specifications are emphasized, one with waiting periods that differ by cause, and one with a uniform waiting period allowing aggregation into a simpler three-state model. We now move to the economic and contractual foundations of the chapter. Before introducing transition rates and reserves, it is important to understand why long-term care is difficult to insure and why the definition of dependency plays such a decisive role in the design of the product. Long-term care insurance matters because demographic change is increasing the number of elderly people who will need assistance in daily living. The aging of large cohorts, combined with continuing improvements in life expectancy, creates a substantial need for financing care at advanced ages. This is not a marginal risk. Dependency may require human assistance over long periods, and the associated cost can be very high for households. The chapter emphasizes that public funding exists, for example, through the former specific dependency benefit, and then the personalized autonomy allowance in France. These schemes provide important support, but they only cover part of the financial burden. This creates a gap for individuals whose resources are too high to receive full public support, but too low to absorb the cost of dependency without financial stress. Private insurance can help fill this gap, usually through annuity benefits triggered by the loss of autonomy. From an actuarial perspective, the question is therefore not only how to price a benefit, but also how to distribute the cost of care between the public sector, families, and insurers in an aging society. Long-term care is particularly difficult to insure because it is a long horizon risk. At policy inception, the future transition from autonomy to dependency may occur many years later, and the duration of dependency may also be long. The actuary must therefore project both the frequency of dependency and the mortality of dependent insureds over a distant horizon. At the same time, the cost of assistance services may increase with medical practice, wages in the care sector, and public policy. Premiums, however, are often fixed or difficult to revise during the contract lifetime. This creates a mismatch between uncertain future costs and relatively rigid financing. The chapter also stresses that the usual problems of personal insurance are present. Adverse selection may arise when applicants have private information about their health or family history. Moral hazard is also possible because dependency can involve judgment and assessment. Finally, many long-term care products are pure risk contracts. If the insured never becomes dependent, no benefit is recovered, which may make the product less attractive to policyholders and encourages insurers to design contracts that limit exposure. Dependency is defined in the chapter as the need for human assistance to perform essential activities of daily living. This definition appears intuitive, but it is not trivial from a contractual point of view. The insurer must define an observable and verifiable trigger for benefits. A classical approach is based on 4 activities: mobility, dressing, washing, and eating. Total dependency is often defined as the inability to perform at least 3 of these activities without assistance, while partial dependency may correspond to the inability to perform at least 2. In France, another important tool is the AGGIR grid, which classifies elderly individuals into 6 groups, from GIR1 for the most severe loss of autonomy to GIR6 for individuals who have not lost autonomy in the discriminating activities of daily living. GIR1 and GIR2 are generally associated with total dependency. The chapter points out that AGGIR is well known and publicly validated, which is useful for insurance contracts, but it also creates a risk for insurers if definitions depend too strongly on future administrative decisions. For this reason, contracts increasingly combine activities of daily living with AGGIR criteria. The next part introduces the stochastic model. The objective is to move from the contractual definition of dependency to a mathematical representation of the insured's life history, including autonomy, entry into dependency, duration in dependency, and death. The figure summarizes the structure of the model used in the chapter. The insured starts in the autonomous state. From this state, 2 types of transitions are possible. The insured may enter dependency due to one of several causes, or may die directly while still autonomous. Once the insured has entered a dependent state, the only remaining transition is death. The arrows therefore describe a hierarchical model because no state can be visited twice and recovery from total dependency is excluded. This assumption is a simplifying but actuarially important modeling choice. The chapter considers recovery after total dependency to be negligible for the contracts studied here. The distinction between dependent states is also important. Benefits may not always depend directly on the medical cause, but waiting periods, underwriting rules, and claim reserves may depend on it. For example, dependency caused by an accident may be treated differently from dependency caused by dementia. The figure also makes clear why duration matters. Once an insured has entered a dependent state, the relevant actuarial question is not only the current age, but also how long the insured has already remained dependent. The formal model starts with a policyholder aged X at inception. Sex is denoted by H for men and F for women, because the chapter explicitly recognizes that the risk characteristics of men and women differ. In particular, mortality while dependent is generally lower for women, and the average age at entry into dependency may differ by sex. The policy is described by a process with 2 components. The first component is the current state, autonomous, dependent due to a specified cause, or deceased. The second component is the duration already spent in the current state. This duration component is what makes the model semi-Markov rather than purely Markovian. The state space contains the autonomous state, several dependent states indexed by the cause of entry, and the death state. If the process is in a dependent state associated with cause J, this means that the insured became dependent because of that medical condition and has not yet died. The chapter gives examples of causes, including accidents, neurodegenerative diseases such as Alzheimer's disease, cardiovascular diseases, respiratory insufficiency, metabolic diseases, cancers, and a residual class for other causes. A purely Markov model would assume that instantaneous transition rates depend only on the current age and the current state. That assumption is too restrictive for long-term care insurance. The chapter explains that empirical studies of dependent insureds show a strong dependence of mortality on the duration already spent in dependency. This is intuitive. The mortality rate shortly after entry into dependency may differ substantially from the mortality rate several years later. The cause of entry into dependency also matters because the survival profile after a neurodegenerative disease, an accident, a cancer, or a cardiovascular event may be different. The age at entry is another crucial variable. Becoming dependent at age 65 does not have the same implications as becoming dependent at age 85. The Semi-Markov framework keeps the model relatively tractable while adding this duration dependence. It does not introduce unnecessary transitions since recovery from total dependency is ignored, but it captures the main actuarial feature needed for long-term care annuities. The benefit is paid during a dependent period whose mortality dynamics evolve with duration. We now translate the Semi-Markov structure into transition rates and probabilities. These quantities are the technical foundation of the chapter because they allow the actuary to compute sojourn probabilities, expected present values, premiums, reserves, and Thiele equations. The slide defines 3 instantaneous transition rates. Rather than reading the formulas themselves, I will describe their meaning. The first rate is the instantaneous intensity of entry into dependency due to cause J for an insured who is still autonomous at age X plus T. It measures the short-term probability of moving from autonomy to the dependent state associated with cause J. The second rate is the instantaneous intensity of death for an insured who is already dependent due to cause J and has already spent duration D in that dependent state. This is the rate where the semi-Markov nature of the model appears because it depends on duration D in addition to current age and cause. The third rate is the instantaneous intensity of death while still autonomous. The distinction between death while autonomous and death after dependency is essential for valuation. If death occurs while autonomous, premiums stop and no dependency benefit is paid. If death occurs after dependency, the annuity stops and the claim reserve is released. These 3 rates therefore describe all possible transitions in the hierarchical model. This slide combines the cause-specific entry rates and states the mortality assumption for dependent insureds. The aggregate rate of entry into dependency is obtained by adding the cause-specific entry rates. This aggregate rate counts only entries into dependency. By contrast, the total exit rate from autonomy also includes direct death while autonomous. This distinction is important because the probability of remaining autonomous must account for both possible exits. The slide also defines the proportion of entries into dependency due to a given cause. It is the cause-specific entry rate divided by the aggregate entry rate into dependency. Finally, equation 7.1 specifies the death rate in dependency. Its interpretation is close to a proportional hazards model. Duration spent in dependency affects mortality through a baseline function that is specific to the cause. Sex and age at entry into dependency act multiplicatively. The age at entry is current age minus duration already spent dependent. This structure is useful because it separates 3 effects: the medical deterioration associated with duration, the sex effect, and the effect of entering dependency at an older or younger age. The sojourn probabilities describe the probability that the insured remains in a given state over a time interval. The first formula gives the probability of remaining autonomous between 2 dates. The important point is that the exponent involves the total exit rate from autonomy, not only the rate of entry into dependency. This is because the autonomous state can be left in 2 ways, either by entering dependency or by dying directly. The second formula gives the probability of remaining in a dependent state associated with cause J. Here the integration follows the death intensity while dependent, and this intensity changes with both calendar time and duration in dependency. The duration at a future date is the duration already accumulated at the starting date plus the time elapsed since then. These sojourn probabilities are the core actuarial building blocks. They enter the valuation of future premiums, because premiums are paid while the insured remains autonomous. They also enter the valuation of benefits, because the annuity is paid only while the insured remains alive after entry into dependency. Finally, they are needed to write reserves and their dynamic evolution. This slide explains how to obtain transition probabilities from the instantaneous rates and sojourn probabilities. The first expression gives the probability of being dependent at a future time due to cause J, with a duration not exceeding a specified value. The interpretation is by conditioning on the time of entry into dependency. The insured must first remain autonomous until the entry time, then enter dependency due to cause J at that time, and finally survive in the dependent state until the future date. The integral adds all possible entry times compatible with the duration constraint. The second expression gives the probability of death before the future date starting from autonomy. It separates two paths. The insured may first enter dependency, survive for some time in the dependent state, and then die before the valuation date, or the insured may die directly while still autonomous. This decomposition is important for long-term care annuities because the financial consequences are not the same. Death after dependency terminates an annuity that may already have started, whereas direct death while autonomous ends the contract before any dependency benefit is paid. We now turn to the actuarial valuation of the contract. The model just introduced will be used to compute expected present values, the unisex premium under the equivalence principle, mathematical reserves, and Thiele equations when waiting periods depend on the cause of dependency. The reference contract is a long-term care annuity. It pays an annuity at rate B once the insured is totally dependent and remains alive. Premiums are paid at rate PI only as long as the insured remains autonomous. They stop when the insured becomes dependent or dies. The chapter introduces waiting periods to limit adverse selection. The waiting period depends on the cause of dependency. There is no waiting period for dependency caused by an accident. There is a 3-year waiting period for senile dementia or Alzheimer's disease. For the other causes, the waiting period is 1 year. The reason for this design is actuarial and underwriting related. Some causes may be more predictable at inception or more exposed to anti-selection, so the insurer delays benefit eligibility. If dependency occurs during the applicable waiting period, the annuity is not paid. Instead, the premiums already paid by the insured are refunded through a return of premium benefit. This clause matters for pricing because the refund is proportional to the premium itself and must therefore appear in the equivalence principle. This slide presents the expected present value of future benefits and future premiums for an autonomous insured. The first expression should be read as follows. For each possible cause of dependency, the actuary integrates over all possible future entry times. At each entry time, the insured must still be autonomous, must then enter dependency due to that cause, must satisfy the relevant waiting period condition, and must receive the value of a future annuity while dependent. The term involving the annuity value after entry is the expected present value at the time of entry of 1 unit of annuity paid to an individual who became dependent due to cause J. It depends on the survival probability in the dependent state and on the discount factor. The last expression is the value of future premiums while the insured is autonomous. It integrates the probability of remaining autonomous multiplied by the discount factor over the remaining lifetime horizon. These formulas emphasize the structure of the valuation problem. Long-term care insurance combines the probability of reaching dependency, the duration of survival after dependency, the waiting period rule, and the payment pattern of the annuity and premiums. The premium formula is obtained from the equivalence principle. The expected present value of future premiums must equal the expected present value of annuity benefits plus the expected present value of the return of premium benefit. Because the premium is unisex, the formula combines male and female actuarial values using the proportion of men in the portfolio at inception. The chapter stresses that unisex premiums do not mean that male and female risks are identical. The valuation is still performed with sex-specific transition probabilities and survival probabilities. The final premium is a weighted average constrained by the product design. The second formula gives the mathematical reserve for an autonomous insured at time t. It is the expected value of future benefits and potential refunds, net of future premiums. The proportion of men among autonomous insureds at time t is not necessarily the initial proportion because male and female exit rates from autonomy may differ. This dynamic sex composition affects reserves and is one reason why the chapter carefully distinguishes sex-specific models from unisex pricing. The Thiele equations describe how reserves evolve over time. For an autonomous insured, the reserve increases because of interest accumulation and because premiums are received. It also changes when the insured enters dependency. In that case, the autonomous reserve is replaced by a claim reserve associated with the relevant cause of dependency. The equation therefore includes terms measuring the gap between the autonomous reserve and each cause-specific claim reserve, weighted by the corresponding transition intensity. Direct death, while autonomous, releases the reserve since no future benefit remains to be paid. The claim reserve equation has a different interpretation. Once the insured is dependent due to cause J, the reserve earns interest and is released at death through the mortality intensity in dependency. At the same time, it decreases because annuity payments are made when the waiting period condition is satisfied. The terminal condition is 0 at the limiting age because no future payments remain beyond that boundary. These equations are useful not only for theoretical valuation, but also for numerical implementation, because they give a dynamic alternative to integral formulas. The previous part required cause-specific dependent states because waiting periods differed across medical causes. The next step considers a simpler product design in which the waiting period is the same for all causes. This allows the model to be aggregated into 3 states. When the waiting period is identical for all causes, the medical cost no longer determines whether the annuity is payable. The contract can therefore be valued in a 3-state model with autonomy, dependency, and death. The payment functions become simpler. Premiums accumulate while the insured is autonomous, and annuity benefits are paid only if entry into dependency occurred at least 1 year earlier. However, aggregation does not mean that causes can be ignored completely. The aggregate entry rate into dependency is the sum of the cause-specific entry rates, but the mortality of dependent insureds remains a mixture of cause-specific mortalities. The weights in this mixture depend on the distribution of causes at entry and on survival within each cause-specific dependent state. This is an important actuarial point. Even if the product does not pay different benefits by cause, the mortality of the dependent population still reflects the underlying medical composition. Once the aggregate quantities are constructed, the same valuation logic applies: expected present values, the equivalence principle, autonomous reserves, claim reserves, and Thiele equations have the same structure as before, with aggregate dependent state quantities. The final section summarizes the main actuarial message of the chapter. Long-term care insurance can be analyzed with a tractable multi-state model, but the model must preserve the duration dependence of mortality after entry into dependency. The main conclusion is that the semi-Markov framework captures the key actuarial feature of long-term care insurance. After entry into dependency, mortality depends on the duration already spent in that state. This feature cannot be represented adequately by a simple Markov model depending only on current age and current state. Cause-specific dependent states are useful when contractual rules depend on the medical condition causing dependency, as in the case of differentiated waiting periods. They are also useful for underwriting and for calculating claim reserves that reflect different mortality patterns after dependency. When the waiting period is uniform, the model can be simplified into a 3-state structure, but the aggregate mortality and dependency must still be constructed from the cause-specific components. The chapter remains deliberately focused on total dependency and excludes recovery, which keeps the hierarchy simple. Natural extensions would include recovery from dependency, partial dependency states, temporal deductibles, assistance services, and hybrid products combining long-term care protection with savings. These extensions would require additional states or modified payment functions, but the same actuarial logic would continue to apply.